These policies are structured with the highest premium for the smallest death benefit allowed by the IRS. And it's just the opposite of what you've probably heard most of your life and what you see the ads on TV and radio. It's that we can get you the biggest death benefit for the lowest amount of premium. Our approach is exactly the opposite. So this allows for the smallest expense for the death benefit and the largest benefit for your cash account while you're living. And that's why it's really a living benefit, a living asset. So the goal is to build your cash value in your policy. So step one is you make your premium deposit, and that's the amount that you put into your contribution amount you put into your IUL each year. From that, the insurance company deducts the policy charges, which, like I said, are some of the lowest in the entire industry. And many, depending on how we structure your policy, your age, and lots of variables, but many times the policy charges can stop after a fixed number of years and go completely to zero. And then what's added to your cash value each year is either the dividends paid by the company, depending on the type of product that we set up or that you choose, or the crediting rate from the indexes, which we'll talk about in just a moment. So that all of those factors contribute to what your end of the year cash value amount is. So let's take a look at what differentiates the IUL from other types of permanent life insurance that's used for cash accumulation. The growth of the IUL policy's cash value is based on the performance of an equity index, usually the S&P or other similar indexes, and it does not include dividend earnings. Okay? The index earnings are collared by a cap and a floor, so they have a floor level and a cap level, which I'll show you in just a moment. Most other policy returns are based on a flat crediting rate that's established by the insurance carrier and is often adjusted from time to time. So, for example, today, as of today, the current assumption universal life, or what they call the UL, the policy returns are based on a flat dividend rate that's established by the insurance carrier, and they have the ability to adjust it from time to time. And typically, these range from a 2 to 5% return per year. With whole life, the policy returns are based on the actual investment of returns of specific equity investments and typically range from 4 to 7%. The variable universal life policy returns are based on actual market returns, and they can be subject to market losses, which we're not about market losses with our program. So this is how the index is credited to your cash account. Like I say, we have the 0% floor and the 17% cap. So if the market any given year, and this is the big key of the IUL program, if the market, let's say one year the market has a 10, 20, 30% drop, then you are protected with a 0% floor. So you just don't get any additions added to your cash value account that year. But most importantly, you have zero losses. And then when the market is up, you get that amount. So if the market went up, let's say 20% in a given year, then you would only be credited for 17% of that 20% gain. But we'll show you in further videos how this proves out over the long run. Here's a quick example. So the red line is in 1997 is an individual invested $100,000 into just straight into the S&P 500 index. And many investment gurus and advisors say that's one of the smartest things that you can do instead of playing individual equities or mutual funds, to just put your money into the S&P 500 index, and it outperforms the huge majority of professionally managed mutual funds. So you can see when they did that, and over the period of time, that grew to $146,000. However, the green line is where they put the same $100,000, but they put it into an IUL. And because there's zero losses in the IUL, there's no down years, you can see the difference. The funds in the IUL grew to $316,000, which is amazing. So you see the difference in the dollar difference in returns, and you can see the percentage difference in returns. So we're comparing to a very, the S&P 500, like we said, just a very respected index that lots of people love and invest heavily in, compared to the IUL.